Hello friends, today we will study new topic capital structure from corporate issuers. Very important from exam point of view, of course. What are the learning outcome we are going to target today? First of all, we will try to calculate. Calculate means there will be certain numerical calculation and interpret the weighted average cost of capital means WACC, WACC. So what is WACC and how it is calculated, that we are going to do today. Number two, the second learning outcome, that is explain. So you have to explain factors, determinants affecting capital structure and the weighted average cost of capital, WACC. So what are the determinants of capital structure and WACC for an organization? So here we will try to understand what is capital structure, what is the optimum level, what are the objectives, and what factors, microeconomic factor, which are going to affect our this capital structure. So let's start with today's work. So two learning outcome we are targeting today. One numerical, second is more theoretical point of view, important from theoretical point of view. Let's start WACC. So first of all, what is WACC? Weighted average cost of capital or cost of capital. Sometimes we say COC, cost of capital, and sometimes we say WACC, weighted average cost of capital. So cost of capital, also called as required rate of return, is composed of cost of debt and cost of equity. So we have already used this cost of capital for discounting in case of valuation and in case of NPV calculation. So what is cost of capital? It is the combined required rate by both type of investors, that is equity as well as debt. So now how to combine this overall cost of debt and equity, and first of all, how we are going to calculate cost of debt and cost of equity. So calculation of cost of debt is covered in fixed income module. Calculation of cost of debt is covered in fixed income module, where we will be calculating yield to maturity, etc. Depending on the price, depending on the maturity value, par value, number of years, frequency, periodicity, and the coupon rate. So there we will be calculating cost of debt using the YTM approach. Next, cost of equity is part of equity module, where we will be using CAPM, capital asset pricing model, where cost of equity KCE is equals to risk-free rate plus return on market index less risk-free rate multiplied by your beta of security. So from these two different modules, we will be getting the cost of debt and cost of equity. And in this particular topic, capital structure, what we are going to do is combining these cost of capital and finding out what is the overall cost of capital. So how to combine it? Just by adding? No, because the values will be different. The invested value, invested amount will be different from both debt and equity holders. So we have to consider that amount also, because these costs are in form of percentage. So we have to relate it with the value invested. So what we are going to do, we are going to calculate the weighted average overall cost, and the weighted average, in case here the weights will be equals to the amount invested by these two type of investor. Next, of course, we understand that debt is less risky because they have priority claim in the current income, as well as at the time of winding up or liquidation of the company. That's why their risk will be lower. Debt investors' risk will be lower, so they will be expecting less than the equity shareholders. Next, one more interesting part is generally in most of the jurisdiction, interest paid to, that coupon paid to debt holder, debt on debt by a company is generally tax is chargeable under tax. It means it is deductible while calculating the taxable income. So when it is deductible while calculating the taxable income, it means the tax expense of the organization will come down because of the interest paid on debt. So if tax expense is coming down, it means the organization is getting some benefits, savings, and we call that is tax shield. So if there is 100 rupees of interest which is charged in the profit and loss statement, income statement, it means your profit will come down by 100 rupees. And if 30% is the tax rate, so there will be a reduction of, there will be a saving of tax expense by 30 rupees, because profit has come down by 100 rupees. 100 into 30 means your 30 rupees. So there is a benefit of 30 rupees on the of tax savings on the interest expense. So what is the net expense which is coming as a burden on the organization? It means the net expense is 100 rupees paid as interest less 30 rupees saved on the tax side. So net cost is only 70 rupees. So that 30 rupees saving we should be considering while calculating the overall cost of capital. So that we will consider in the form of 1 minus tax rate, because what is the calculation of 70? 70 is 100 minus 30. What is 30? 100 minus 30% of 100. It means it is 100 1 minus 0.30. So what we can say, your after tax cost of debt, after tax, we generally say after tax cost of debt is equals to your before tax cost of debt multiplied by 1 minus tax rate. Next, in case of capital allocation decisions, NPV calculation or IRR calculation, can we use this WACC directly for calculation of NPV and comparison with IRR? No. Sometimes the new projects, whatever company is now taking or thinking to invest in, their risk factors may be different from the existing business of the company. In that case, the WACC calculated by the company, whatever WACC company is paying on its existing business to its investor, should be adjusted as per the risk profile of the new project. So what we are going to do, WACC after adjustment of project specific risk is what issuer uses as R for required rate for NPV calculation or as hurdle rate for comparison of IRR. So few things we have understood. Number one, what is WACC? WACC is combination of debt and equity. It's not simple addition. It will be a weighted average, where weights will be equals to the value of debt and equity. Now, what is this value? We will come to that in the next part. So, second thing, cost of debt should be lower than cost of equity because debt holders are having less risk. Why they are having less risk? Because first they have priority claim over equity, and second, sometimes debt is secured also by some collateral. So that is why their risk is lower. So their expectations should be lower. Number three, debt is chargeable. Debt interest is chargeable under the income tax acts, generally income tax laws. That's why we generally get tax shield on the interest paid on the debt. So what we have to consider is net of the tax shield cost only in calculation of WACC. And number four, while taking the capital allocation decision, that is NPV and IRR calculation, WACC of the company should not be used directly if the project specific risks are different from the existing business of the risk. So if project risks are different, risk profile is different, your existing WACC should be adjusted, increase or decrease depending on risk is increasing or decreasing by taking that new project. Because if you are going to take higher risk project, your investors will expect more from that project. So you have to adjust your WACC and then only you have to use in the capital allocation decisions. Now question comes is what weights we should be using or how weights will be calculated for WACC. So weights can let's understand this cost of capital, whether it's cost of debt or cost of equity. Investor is expecting on what value? This 10% cost or 15% cost, whatever is the percentage number. Investor is expecting 15% return on what value? Investor is expecting this 15% on the value which he is investing in the company, in the issuer. So what is the amount which investor is investing? It is the market value. When an investor is purchasing equity share, he has nothing to do with the par value or the book value in the balance sheet of the company. What he is investing is the amount of the price what he is paying in the market. So if a issuer, let's say XYZ company, is par value is 100 and its book value is, let's say, 200 because of the retention, reserve and surpluses, but the market price is 3,000 rupees. So if as an investor, if I am purchasing that equity share, I am investing 3,000 in that company. So I will be expecting return of 15% from that CAPM model on the 3,000 rupees what I have invested. So If I'm expecting 15% on my market value, so market value should be the better choice for calculation of weights for WACC. So first way to calculate weight is weight for debt and equity is the market value weights, because the opportunity cost, whether it's from YTM format for cost of debt or from CAPM for cost of equity, is coming using the market value as base. So that should be used as the base for calculation of weight for the WACC. Next, second, sometimes target weights are also used. Now, what is target weight? This we will discuss in the later part, where where company may use target weights rather than using the actual market weight. There are reasons, because market values fluctuate very frequently. Number two, company is bothered about what is invested, what company is investing in the new project, not the value at which investors are transacting in the market. So there are reasons. There are justification for using this target weights, and there are ways to calculate these target weights. But let's continue with this topic, because target weight we will cover in the last part of this capital structure module. So two ways to calculate. First is market value. Second is target weight, what companies management want to have for their business. The better choice will be market value weights. Next, one more thing in addition, sometimes issuer may use some different form of financing also. Example is preferred stock. In India, we have preference shares, or some shares, equity share with differential rights also. So in that case, in calculation of WACC, in addition to cost of debt along with its weight, cost of equity along with its weight, that third source cost should also be considered after taking tax effect, if there is any, along with its weight for calculation of WACC. So first, what is the formula for WACC? Weighted average is very clear. Weighted average of anything is weight multiplied by sigma of weight multiplied by your variable. So we have two costs, two sources. If we are having only debt and equity, so weighted average cost of capital will be weight of equity multiplied by cost of equity plus weight of debt multiplied by cost of debt. But in case of cost of debt, we have already understood there will be a tax shield, so that should also be considered. Now, if there is a third source of finance also, which is used in case of in case of an issuer, let's say preference stock, and in generally preference shareholder gets dividend, and dividend is generally not chargeable under the income tax laws. So there will be no tax shield. If it is, we should be considering that. Then in that case, that weight of that preference capital should also be multiplied by your cost of preference share. Cost of preference share will be almost similar to what we have done in the YTM calculation. So let's stick to the two sources. Next, let's go for some illustrations. We have weight of debt of a company, assuming we are given with the weights. Weight of debt is 30%, weight of equity is 70%. Very simple 1 minute question. Debt investors required rate of return before tax. Before tax is 10%. So we have weight of debt equals to 0.3. We have weight of equity is 0.7. We have cost of debt equals to 10. And the required rate of equity, we have KC equals to 15%. And first it says marginal tax rate is 20%. So first case, what is WACC? WACC will be equals to weight of equity 0.7 into 15 plus 0.3 into 10 multiplied by 1 minus 0.2. What is the value we are going to get? So this is 15 into 0.7, then 10 into 0.3 multiplied by 0.8 plus the overall WACC is 12.90%. Next case, what it says, if marginal tax rate increases to 25%, what will happen? if marginal tax rate increases to 25%, what will be the impact on WACC? Whether WACC is going up or down. Let's see. Weights are same, plus 0.3 multiplied by 10 multiplied by 1 minus 0.25. So in this case, 0.3 multiplied by 10 multiplied by 0.75 plus your value 10.5 is 12.75. So here we conclude that if tax rates increases in the jurisdiction in which issuer is operating, in that case your WACC will come down. There will be advantage of increase in tax rate in the form of decrease in WACC for your calculation of capital allocation decision. Next, second part. So in first illustration we were given with the weights. Now we are required to calculate weights. What it is saying, source. There are two sources. Common stock means equity, and second is equity, and second is your bonds means debt. Book value is 10 lakhs and 15 lakhs. Before tax cost is given. They are also saying that market price of equity share is 300 rupees and tax rate is 30%. Can we calculate the market values? Yes, we can calculate the market values. Market values for common stock, it's a 10,000 share for 10 lakhs. So it is having a face value or par value of 100. Priced at 300. So value in the market must be 330 lakhs rupees or 3 million rupees. Next, debt is having the same value because no price is given, assuming it is trading at par, assuming. Next, let's calculate the weight of equity first. Now, which weight we are going to use for calculation of WACC? So here, let's assume market value. Market value weights are used. Market value weights are used. In this case, weight of equity will be, market value will be 3 million divided by total is 4.5 million. And weight of debt will be 1.5 million over 4.5 million. What is the WACC? WACC in this case will be equals to 3 on 4.5 multiplied by 12 plus 1.5 over 4.5 multiplied by 7 multiplied by 1 minus 0.3. Let's calculate the values. 3 over 4.5 multiplied by 12 is equals to 8, and 1.5 divided by 4.5 multiplied by 7 multiplied by 0.7 plus 8 is equals to 9.633% as your WACC. Next part, second, if assuming we are using target weights, and target weights are assuming equals to book value, assuming target weights are equals to book values, in that case your weight of equity will be equals to, weight of equity will be 1 over 2.5 million and weight of debt will be 1.5 over 2.5 million. So let's calculate the WACC again. So in that case, WACC is equals to 1 on 2.5 into 12 plus 1.5 over 2.5 into 7 multiplied by 1 minus 0.3 is equals to, let's see what is the value, 12 divided by 12.5 and 1.5 divided by 2.5 multiplied by 7 multiplied by 0.7 plus is equals to 7.74%. So these are the two calculations of weight, and we have done the calculation of WACC also. Hopefully WACC calculation is everyone understood WACC calculation. So let's move to next part, that is capital structure, and what are the determinants of factors which are going to affect the capital structure. Theoretical topic, but important from MCQ point of view, because they will give choices and they will say which the particular situation is related to which factor. So let's understand what is capital structure. So what is capital structure is, of course, the structure of capital employed, how we are financing our business, what sources are used in what ratio. Equity is used, 100% equity is unlevered, or 50-50 or 60-40. That combination, that structuring of your capital employed is capital structure. Now, while forming this capital structure for the company, what are the objectives? And can we achieve best structure? Yes, there are theories we have in our course. One is Modi-Gilani-Miller approach. Second is pecking order theory. Third is static trade-off theory. So there are theories which will guide us to find out the best capital structure, which will guide us to find out the best capital structure. But when we are saying what is the optimum or best capital structure, first of all, what is the objective we want to achieve? So there are two objectives. Number one, what we want to do is we want to, because capital employed means source of finance, and source of finance is going to create cost, will create a cost for the company, because investors are expecting something. Whatever investors are expecting is a cost for the company. So what we want to do, revenues are generally maximized and cost is generally minimized. So we want to find out a capital structure which will minimize our overall cost, that is WACC. So first and the most important objective is capital structure which result in lowest WACC. Lowest WACC. Now, how WACC is based on cost of equity and cost of debt. How this cost of equity is going to fluctuate or cost of debt is going to fluctuate, it will increase or decrease on what factors, that we are going to cover next. Second, what is the second objective? Second objective is to match the asset and liabilities. Because when we are using finance from our investor, we are going to invest somewhere. So if we are going to invest somewhere, there should not be a mismatch of timing. Short-term sources should be invested in short-term asset, and long-term sources should be used for long-term assets. Why? If there is a mismatch, let's assume we are using short-term sources of finance for investing in the long-term assets. What will happen? At the maturity will come soon for financiers. They will come and ask their money back. If in case they ask their money back, they don't want to roll over, then can we sell those long-term assets to redeem those obligation or pay off those obligation? If we sell our plant machinery and land and building, how business is going to continue? So that is going to create a stress for the business. Second way, if we consider long-term finance for our short-term assets, what will happen? The first thing is going to impact the WACC itself, because generally long tenure financing is going to have a higher cost than the short tenure financing. So it is automatically defeating the first objective. And second thing is, once the short-term asset is liquidated, again we will search for additional investment opportunities, and if we do not get a sufficient investment opportunity, how we are going to pay cost of capital, expectation, required rate of return of our investors? So there will be always issues. In case short-term financing is used for long-term asset, the risk is called, the uncertainty is called as rollover risk, whether we will be able to roll over our liabilities or not. And in case we are using long-term financing for short-term asset, the cost will increase. So in ideal situation, your asset and liabilities timing should match. That is the second objective of capital structure, where possible and economical. Of course, we have to see the cost aspect also. Matching the liquidity or timing, asset liability matching of capital structure with that of capital investment. So second is related to timing and first is related to cost. So let's understand what are the determinants which are going to affect this capital structure decision and the objectives. So determinants affecting capital structure, very small topic. There are 4 parts. Determinants, factors affecting capital structure. So they may give a situation, they may ask you in the MCQ, it is related to which factor. So first, few factors which are affecting amount, how much you need capital, and the type of financing, whether you should get a debt or whether you should get equity. So few factors are those type of factor, means this is impacting our objective too, which is related to the timing, which type of source we should be using. So the two factors, one is called as business model, what type of business you are running, and second is the position in the corporate life cycle. Corporate life cycle means it's generally related to product life cycle, means whether you are running a company in the startup phase or the growth phase or the stability phase or the maturity phase. Of course, we are not going to talk about the decline phase, because in case of decline, you don't need finance, you are liquidating your business. Next, last one is second factor is which is going to affect your objective number one, that is calculation of WACC. To minimize the WACC, what are the factors you should consider? So cost of debt and equity will be affected by number one, top-down factor from economic point of view, economy point of view, that affect debt and equity market generally, inflation, GDP, per capita income, liquidity in the market, money supply and demand in the market, that those factors. Second factor, which are specifically related to an issuer, about its corporate governance, ESG factors, business model, operating leverage, financial leverage, sales risk, all those factors. Higher the risk, higher will be the expectation of the investors. So your cost of debt and cost of equity will rise. So four type of factors which are going to affect the capital structure. Number one, business model. Number two, your position in the corporate life cycle, which are going to affect your amount and timing, amount and type of finance. And second, two type of factors which are going to affect your cost of debt and equity is your economic factors, macroeconomic factors, which are affecting overall economy per se, and your debt and equity investor equally. And second thing is issuer specific factor, sales risk, operating leverage. We will study in different module. Financial leverage we will again study in the different module, and the other factors related to issuer. So let's understand business model one by one. So these are the four factors which we have to understand. Business model. Now, business model means what type of business you are running. What type of means what type of assets you need for your business. There are two type of business. Generally, one is called as capital intensive business. More fixed assets, tangible assets are required. Second is asset or capital light business. Service sectors, teachers. In few sectors, more assets are required. For more assets, you need more finance. Where asset light business is an asset light business, then less assets are required. More work is done on human capital side rather than physical capital side. So in that case, less finance will be required. So what are the capital intensive business? A business that require lot of assets, plant machinery, land and building, furniture, fixtures, your stock inventory you need to hold. All these are going to require more finance. Manufacturing, real estate, natural resources, mining, etc. In that case, your sales to asset ratio will be, of course, low because your denominator is higher. Your capital expenditure to sales will be, of course, high because you will need more capex every time when you want to expand or when even for continuing your business. High net working capital will be required. High net working capital will be also required. Working capital will be also required. Why? Because you need to hold more inventory. You have to give more credit to your receivables. Next, and sometime for these business, even government influence the capital structure, that you need to bring this much of equity. For banking, generally there are rules for capital adequacy norms. So these business are called as capital intensive business, where more capital is required in form of financing from your investors. Next, second is asset light, more generally service sectors, technology companies, where human capital is more important rather than physical capital. So of course, asset turnover will be higher because sales upon assets are lower, base is lower, so ratio will be higher. Less capex is required. Main asset is generally in these cases, main asset is actually cash, because they don't need, or they need very less plant machinery. So generally it is going to have excessive cash and intangible copyrights, patent, etc. Reason for lesser need of external financing, and these capital light business need less finance also, external finance. Why? Number one, generally they charge upfront. Service industry generally charge upfront from their customers. Second, they operate through a network of others. Service industry generally have outsourcing agreements with other service provider, and outsourcing agreement, the vendors are going to manage assets. So for a service sector industry, they don't need to have asset in their balance sheet. In case of employees, to keep them motivated, rather than going for absolute cash payment, they generally give ESOP, so that the employees remuneration get connected with the company's profitability. Higher the profitability, higher the market price, and higher the value of compensation or rewards for the employees. So even because the human capital needs to be motivated in these business, so generally the employee compensation is also including rather than cash incentives, they include ESOPs. And by exercising ESOP, in fact, they get cash rather than paying cash. Issuer is going to get cash. And since they have less assets, there will be less depreciation, amortization, less plant machinery, rental, etc. costs. So they become profitable from very early stage. That is why these businesses need less capital. So it depends on your business model, how much amount you need for your capital requirement. Number one. So this is your first factor. Number two, stage of life cycle. There are generally 4 stages, but capital is generally required in first 3 stages. First is your startup, the initial stage. Second is your growth, when you are rising, your business is increasing. And third is mature or stable. And last is declining. In declining, nobody is going to finance. So in fact, companies getting liquidated, assets are being sold. So there is no finance requirement per se. So 3 stages we are going to talk here. First, startup. What are the features? So they may give you features and they may ask you to identify the phase, or they may give you the name of phase and they may ask you what is the situation of this particular item, what is the situation of revenue, or what is the situation of free cash flow. Free cash flow, we already know that free cash flow means your cash flow from ops less your capital expenditure, capex. So initial stage revenue is initial revenue growth is at a very initial phase. At a growth phase, it will rise. We have this graph which will make things easy. Startup phase, your first stage, your startup phase, your growth is at a very slow pace. In fact, for few starting period, for very initial period, you may not get any growth, any sales. In fact, you will be required to cash burn or do expenses without generating sales to create your name, brand, or establish your product. Then as you move to second phase, your growth will rise with a rapid pace. Your revenue will rise with a rapid pace. And as you move to the last stage, that is third stage, maturity or stable phase, now your revenue is stabilized, slow pace, but more predictable. You can predict or forecast what revenue you may be getting in the next upcoming period. So situation of cash flow, of course, initial first stage, you will be doing cash burn. Second stage, initially there will be negative cash flow, which is improvising into positive side, rising, and visibility is improving because your revenue is increasing. And the last stage, that is maturity, your sales are now stabilized. You can predict very easily how much sales is required and how much expenditure is required. So in that case, you will have stable and positive cash flows here. Risk wise, initial phase, your business risk, operating risk will be high, very high, because there are uncertainties which will impact your business. Your business may get a good growth, and business may get a very bad, difficult phase also. So the uncertainty is high because your product will be acceptable or not by the market. It depends on many situations. Second, as your growth stage starts, your product is now stabilized, market know your brand, your customer are accepting your product, so your risk will reduce. And at the last stage, maturity, since things are now very much stable, so risk will be at the lowest point. Debt availability, of course, initially no one wants to take risk. So debt holders are not interested, or very little debt you will be getting in the form of lease rents or convertible, which gives an option to debt investor to convert into equity share. Only then, in fact, issuer wants to convert them into equity share, so that if there are no sufficient interest, profit for payment of interest, that can be converted into equity. So next is as your company grows, your debt availability will rise, and at the last stage, that is maturity stage, everyone want to invest, so debt availability will be higher. Second stage, growth stage, still debt investors are interested, but they want security, maybe in form of collateral, guarantees. And last stage, since your business is at a stable stage, significant debt is available, and that too at a unsecured manner, and that too in an unsecured manner, without giving any collateral or guarantees. Equity financing, initial stage, promoter, your angel investor, venture capitalist will be the main financiers for the business. As you move to second phase, your debt component is rising, but still your equity is the major source. And at the third phase, your debt is the major source, significant. And here now company is already stabilized, your product is already accepted in the market, you are generating profit, so now it's time to pay back. So more dividends, more buyback payouts will be there to equity holder here. Rather than getting equity from investors, you will be paying them back. So these are the two factors which are affecting your business model, and second is your life cycle stage is going to impact your amount and type of financing. So this type of financing thing you got from your product life cycle phase, that at what stage you are going to get which source in your capital employed or capital structure. Next, last two factors which is going to impact your WACC, cost of equity and cost of debt. First, top-down approach, top-down factors. This is more related to macroeconomic factor, GDP, inflation, exchange rates, per capita income, demand and supply of money. So all these macroeconomic factors and country-specific factors, monetary, fiscal policies, all these, what is the rate of sovereign debt in the market, your credit spread, these are going to drive your cost of debt and cost of equity, and they will move in the same direction. When cost of debt is increasing, cost of equity is also generally increasing, and if they are going down, they will go down together. So these include financial market and industry condition, nothing to do with a specific issuer. The second one is and they will move in the same direction, because inflation will increase your yield requirement as well as your cost of equity also. If recession is coming, both will have get impacted negatively. So next, issuer specific factors. So issuer specific factors include number one, sales risk, your elasticity, price elasticity of demand, income elasticity of demand, cross elasticity of demand, how much your sales is uncertain. So that is the first risk which is related to a particular issuer, not to the overall industry. And if the risk is high, investors' expectation will be high. If the risk is low, investors' expectation is low. Example is, it depends on the industry generally. For cyclical business, commodity business, the sales risk will be high. But for, it is assumed generally, pharma business, FMCG business, sales risk is generally low. What do we mean by sales risk? It's the uncertainty, deviation from the average. So pharma and FMCG, whether it's a boom or a recession phase in the business cycle, your pharma sales and your FMCG sales will not fluctuate that much in comparison to your commodities or your cyclical businesses sales, your tourism, etc., etc. So this is going to drive your cost of debt and equity. Number two, your operating risk. Operating profit risk, profitability risk. It's it is measured by your DOL, degree of operating leverage. What is degree of operating leverage? It is percentage change in your EBIT with respect to percentage change in sales. So how much your profitability is moving with respect to changes in the sales. If sales is changing by 10% and if your EBIT is moving by 30%, it means you are having a 3 times profitability risk. For every 1% movement in the sales, your profit will move 3 times, both in positive and negative sides. So majorly related to fixed cost in your income statement. So that is also going to drive your cost of capital, both debt and equity, because higher the risk, higher will be the expectation. Numerical part of degree of operating leverage and how it is going to impact your return on investment, that we will cover in the separate module. Next, financial leverage. Degree of financial leverage is percentage change in EPS with respect to percentage change in EBIT, and this is because of presence of interest in the fixed cost, interest in the income statement. Higher the interest component in your income statement, more will be the DFL, and higher the DFL, it means your earning for equity shareholder will fluctuate higher for every change in the EBIT. So this is creating additional risk for equity holder. So if additional risk for equity holder is there, they will expect more returns. Next. And last part is collateral. What type of collaterals are available for the investors for giving, for securing their debt obligation? If they have good collaterals, then they are going to get debt at a cheaper rate. And if they are not having collaterals, acceptable collaterals, of course, since the debt holder will feel more unsecured, debt holder is going to ask more returns. So what are the four determinants? Four determinants. Number one, first, which is affecting amount and type of financing, including business model, capital intensive or capital light business. Second, your stage of life cycle. In the business stage of life cycle, it can be initial, startup, growth, and growth or rising, and the third one is maturity. Two factors affecting your cost of capital, cost of debt and cost of equity. First is your top-down factors that include your macroeconomic factor, and second is issuer-specific factor, which include sales risk, operating risk, profit risk, financial risk, financial leverage, and last one is your collateral availability. So MCQ may come, they may ask you this factor is related to which determinant, you have to identify that. So with this, let's conclude today's work. So done. Thank you so much. Thank you everyone.